So here we're going to pivot over to the US, and we want to look at what are some of the different shifts that we're seeing. And I think it's important when you look at, and again, kind of bridging what we've talked about in the segment one of the medium-term risk appetite and how that's looking. And one of the things that we talked about is that everyone had gotten too bearish, and you started to see some of that reversal. And again, you're going to have some of those moves. You're going to have everybody gets too bearish. You have that 90, 100 handle day. But as long as some of the key metrics don't change, you're going to have that correction back down because it'll be a short-lived, very aggressive bear market rally. And one of the key things is the end of the 30-year long government bond bull market. For those that have been following me, I've been talking about the end of the bond bull market since the end of the beginning of last year, with the view that it's happening. It was happening, and it doesn't end pretty. It's not a pretty end. It's something that takes time, but that's where you start looking at the long end of the curve and where we sit. There was another weak auction for the 20-year, and you saw a movement higher in terms of rates because there's that pressure in terms of, yes, economic growth is going to wane, which should bring rates down. But because there's so much physical paper, who's buying it? Like, who is going to buy that paper, which is why you've seen the volatility pick up. Your biggest buyers have stepped away, but it's never going to be in a straight line. And we've seen that here. So when you look at foreign net transactions of U.S. Treasury bonds and notes, ticked higher in August, but we know they ticked down in September and October. So again, you're going to have a back and forth in terms of who is buying what, when. And now when you look at the Fed Beige Book, which just came out, they're saying the economy, where are some of the comments? So economy expanded modestly, growth widespread, some easing, more growth expected. So when you look at the wage side, the underlying Beige Book, they're essentially putting themselves in a position that, hey, we can still keep raising rates. Like, things are still moving along at a clip that is comfortable enough for us to raise rates, for us to continue based on where is labor, where is the economy. And then the Fed funds rate now seen peaking at 4.5 to 5%. Now, if you remember back in August when everybody told me I was crazy to see something that was going to be closer to 5%, here we are. And now as we progress from August, even from August to October, my view was that the terminal rate had been moved up, and everyone's like, oh, the world can't handle that, which is likely true. The world can handle it, but it doesn't mean that that's not where we're going to go, because we're going to have to tighten to a point where we make a meaningful adjustment in terms of where we sit today. And that's where we see this, again, moving back up. And I think the market has moved further in that pace. But as you continue to see the weakness in the auctions, that's only going to put more tail risk and move us even higher, especially as the foreign buyers continue to be fleeting. This is, again, pushed that U.S. terminal rate to 4.96%, again, close to that 5%. And I was saying this last year, like, just in terms of where the trajectory was. And you can see now that the Fed funds curve, the future curve, is showing that level, but they still have cuts coming in the back of 2023, which is something that we just don't see happening given the pace in which we're going up. And now even Kaskari is saying that it's going to take over a year to see the rate hikes actually filtered through the system, which, as much as it pains me to say it, I do agree with him, which is why you'll get up there and then you're going to hold firm at these levels and you're not going to see a big reversal lower. And another key reason is when you look at the future, if you look at where CPI has been coming in, which is something between 3 and 5%, you get an idea that as we get to the end of the year, we're still going to have a 5% plus inflation rate, a core CPI rate. This isn't even just, this isn't just a top line. This is core. And as we continue to see these pressure points, that's going to keep them very active in the market. And again, trying to bring this under control. Now, the reason why you hear so much about why people care so much, well, the top 1% of Americans own 53.1% of all stocks in the United States. Top 10% own almost 89%, and the bottom 50% own less than 1%. So when you think about the top 10% Americans, they own 89% of the stocks in the country. So when you look at ownership, it's very much top heavy. So when you think about who is the largest in discretionary spending, it's this bracket. So as they see their home prices come down, they see their portfolios come down, they're going to shrink and pull back, even if they have excess savings, purely because they don't feel or look as wealthy as previous, which again is going to hinder a lot of the activity that they're willing to do, which is again also shows that the redistribution that occurred over that time period in terms of the expansion of that top point. And I love the top 0.1% owns 20% of U.S. equities, which is always fun. Now, when you look at supply chain stress, it's coming back down. And again, as it comes back down, a lot of this is driven by that huge slowdown in activity, a normalization in terms of supply chains, and there's some of that back and forth. And to strengthen that point, here you can see the data sets that are from the freight waves. So when we look at the top one, the tender rejection index, a way to understand the balance of supply demand in truckload market, high equals good for carriers, because if you're rejecting tenders, you're like, well, I need a higher price. So then they come back to you with a higher price. So if you're rejecting them at a greater clip, that's better for your rates. Low, which is bad for carriers, where you're just taking whatever work is coming in, regardless of price, if you make money, if you don't make money, because you're just trying to cover some of your fixed costs and letting the variable cost go. And it has dropped to a new cycle low of 4.66%. The only two times it was lower was in the trucking bloodbaths of 2019 and early COVID 2020. And again, that's what we keep talking back to when we look at 2019 on why we were so bearish. This is the example. Look, for those that have asked, why were you bearish in 2019? This is why. You're looking at why, where you saw the different leading indicators, and it's showing something very similar. So now when you look even further out, because outbound tender rejections is in the U.S., now we look at inbound ocean TEU volumes, ocean container volumes bound for the U.S. measured at the point of origin. Volumes have normalized to pre-COVID levels, much to the chagrin of the ocean ship lines that are on the hook for taking delivery of new ships, representing the largest capacity build in history. So now we're going to get an overcapacity, which is going to push rates down even more. But you're seeing less and less volumes, which again points to what we've talked about as this pivot where things are going to continue to get worse. U.S. CPI month-over-month core services came in at 0.8%, and then the contributions to U.S. CPI core services, food, energy, core goods, remember, all of them continue to drift up. And one of the things that when you look at this, you can see that stagflation really starting to settle in as you get a back and forth of what is driving inflation to the next level. And that's where we see a lot of pressure, again, kind of keeping us elevated now with the reacceleration of diesel in October, as well as gasoline versus September. That's going to be another pivot to the upside. So then when we look at CPI, owner's equivalent rent, you get an idea of just how aggressive the moves are. And there's still more to come when you look at the lag that happened between OER and between what was actually happening in the market and what OER was showing us. And a lot of that spread is going to continue to be some of that overhang. So then the University of Michigan monthly change in 1 year inflation expectation sentiment survey was one of the larger spikes over the past decade, as people are finally realizing that what you're hearing on the news from the Fed is not really true. Like, you're not seeing this slowdown in inflation. The view was, oh, we're over the hump, it's going to go down. This is the decline. Instead, everyone's looking around saying, well, I haven't seen it come down. I've only seen it go up, and it's actually up, personally speaking, than what you're telling me it is. So how is this going to decline? And that's where you're starting to see that come through. And this type of impact is going to be a problem when you consider how this is reverberating through the system, because this is how people are going to feel about what they're spending. another record in relative put buying, was one of the bigger drivers of what sent us higher, because all of this that I'm talking about is starting to come to fruition, and people, especially retail, went out and bought puts. So what does that do? That primes the pump for a nice squeeze to really catch people by surprise and eat up and essentially have a lot of these go out worthless, with expiry being this Friday, Saturday, depending on if you're weekly or monthly. So the investor movement index, when you look at the different shifts, again, you saw the shifts overall, and now that we had the rally, we're seeing more pressure on rates. We're seeing more issues in terms of where some of the flows are going to come to. That's going to put more pressure on where things go in the over the next few months. So then when you look at the labor market, Treasury liquidity conditions are tight, which typically leads to near-term market dislocations. Will concerns about financial stability cause the Fed to reverse quantitative tightening despite the strong labor market? The answer is no. That is not going to happen. When you look at liquidity index, it's just you keep papering the town, but you're losing buyers, which is the liquidity problem where you have a buyer strike. But when you look at unemployment, when you look at the beige book, they're showing you that, no, we still have reason to do this, and we're going to have to let the Treasury market take care of itself for a period. And ideally, the Fed the U.S. government wouldn't spend as much, but we all know how that would actually end up and the unlikely nature of that occurring. So then when we start looking at some of the leading indicators, October Empire Manufacturing fell to negative 9.1 versus the estimate of negative 4.3. Prices paid went back up. This is what we've been talking about. New orders expanded slightly, but still on a negative trend. Delivery times fell back into contraction, as we highlighted before, and the work week popped back into expansion, with employment ticking down, but still in an expansion general. So, but then when you look at expected business conditions, it's now negative. So people are still expecting things to get worse. Then when you look at expected shipments going down, so again, when you look at new orders, new export orders, still positive, but moving in the wrong direction, making a multi-cycle low. But then when you look at prices paid, they bounce back up because, again, there's still that inflation in the system, the supply chain, and prices received came down. So prices paid is a leading indicator for prices received, which just, again, points to the fact where they're going to try to recover as much margin as they can, pivoting that back up and providing some of that support to the prices received. ISM output component advanced 2 months, manufacturing output. So it just gives you an idea that the manufacturing side, is only going to continue to slow when you look at the underlying backdrop and how that's pulling lower, with used car value continuing to deteriorate and actually getting much worse as we progress through the end of September. And it's important when you weigh manufacturing activity because industrial production came in at 0.4 versus the estimate of 0.1. Capacity utilization up to 80.3%. Factory production up 0.4%. So again, you're still seeing this, but you're starting to crest. And when you look at those leading indicators, as we showed earlier, when you look at car sales, car prices, used car prices, when you look at a lot of those leading indicators, that's where we see this roll and an acceleration to the downside into year end, especially when you look at the general merchandise stores, inventory to sales ratio. When you look at it, we're back to levels we haven't seen since 2007. And this is just looking at inventory versus sales. So there's too much inventory for the amount of sales that are happening, which is going to slow buying, which is going to show up in the Empire Index, the Philly Fed, the Chicago Fed, because you're seeing these pressure points where you're not getting the same churn in activity, the same churn in equipment, and that's, again, going to move us lower. University of Michigan sentiment moved up to 59.8 versus 58.8. But again, you're seeing you're bumping along the bottom with expectations ticking lower to 56.2 versus 58.3. So people are like, all right, well, things are kind of stabilized, but it's going to get even worse in the future, again, pushing that to the next level. And that is why, and this is part of the reason why. Well, the 30-year fixed mortgage average in the U.S. is back to highs not seen since 2000. And then when you look at the year-over-year percent change, principal and interest, we've had a year-over-year change of over 60%. So again, all of this is going to culminate in people feeling worse and people struggling to spend. Which when you look at pending sales, well, pending home sales are down 28% because of rates, because of this slowdown, which is again being carried out in the University of Michigan statement as well, with buying conditions for various products starting to diverge. Large household durables gotten a bit better. Again, prices have come down. People have been waiting for some prices, but sentiment improving while housing, orange, has fallen lower and is back near the dismal early 1980 levels. Autos have rebounded, but still at an all-time low. But the housing side is back to levels not seen since the 80s, when you had a very big slowdown in the housing space. And that's what we've been talking about and calling for, is this broad slowdown, which we're going to talk about more in the next segment.